Good evening, everyone, and welcome back to Stock Daily. It's Wednesday, November 5th, 10:55 p.m. Eastern Time. The U.S. market staged a solid rebound today, with all four major indexes closing in positive territory. After a series of choppy sessions and mixed earnings results, it feels good to finally see a coordinated move higher across the board. Many investors probably felt a bit of relief, as sentiment in recent days had been pretty fragile. However, just before the closing bell, we saw something worth noting, a sharp drop in the last 15 minutes of trading. That late-day fade shows that while optimism is returning, caution still dominates the short-term tone. Traders remain on edge, watching both macroeconomic developments and technical signals for the next big move. Before we get into the details of individual stocks, it's important to start with the broader picture. What's happening in the bond market, the Treasury Department's latest announcements, and some important geopolitical and policy news that will likely influence market direction in the coming days. U.S. Treasury market and bond yields. The first story that set the tone for the day was in the bond market. The 10-year Treasury yield jumped 1.765%, hitting its highest level in nearly a month. That's a significant move, and it came after the U.S. Treasury Department released its latest refinancing plan this morning. At first glance, the report seemed ordinary. Total borrowing for the quarter is expected to be $1.251 trillion, exactly matching previous forecasts. In other words, there was no surprise in the headline numbers. The Treasury also reaffirmed that it intends to gradually increase the issuance of both bonds and short-term notes over the next few quarters. Normally, that kind of statement wouldn't cause much market turbulence. It signals steady, predictable funding. But then came a twist. The Treasury added a forward-looking note, saying it is already evaluating structural demand trends and considering future adjustments in the auction sizes for fixed-rate and floating-rate notes. That sentence changed everything. Even though they made it clear that no increases will happen in the next 1 or 2 quarters, the fact that they are preparing the market for a possible uptick later was enough to trigger a strong reaction. Traders interpreted it as an early warning, a heads-up that more debt issuance is coming down the line. As a result, Treasury yields spiked, the 10-year climbed to a 1-month high, and bond prices tumbled. The move also rippled across equity markets, particularly interest rate-sensitive sectors like technology and real estate. At this point, with the national debt already exceeding $38 trillion, investors are starting to feel desensitized. Whether it's $38 or $40 trillion, the number itself almost loses meaning. What truly matters is how the government finances that debt and whether investors are still willing to buy U.S. bonds without demanding sharply higher yields. Essentially, the government must keep borrowing, and the question is, who will pay the bill? Higher yields mean higher costs for the Treasury and tighter financial conditions for everyone else. Interestingly, after 2 rate cuts, one in September and another in October, you'd expect yields to fall. But the opposite happened. The 10-year yield kept rising. This strange divergence tells us that investors don't buy the soft landing narrative entirely. The market sees those rate cuts not as a sign of victory over inflation, but as a move that might eventually reignite price pressures. In other words, traders are pricing in a future where inflation may stick around longer than policymakers expect. To hold U.S. debt in that kind of environment, investors want higher risk premiums, better compensation for long-term inflation uncertainty, trade policy, and tariff developments. The second big story today came from Washington. After months of silence, the U.S. Supreme Court finally began hearings on whether to overturn the tariffs implemented during the Trump administration. Early indications suggest that the court is leaning against fully supporting the presidential authority used to impose those tariffs, which could open the door to partial or full removal of some duties. That news immediately sparked strong rallies in stocks that have suffered under tariff-related cost pressures. One of the most notable examples is Lululemon, Lulu. The stock surged 10.43% to $168 after months of brutal decline. Lululemon has faced 2 major challenges. First, it's had internal operational setbacks, inventory and supply chain issues that hurt margins. Second, tariffs raised the cost of imported goods, squeezing profits further. The combination resulted in a steep, almost collapse-like downtrend over recent months. So today's bounce felt like long-awaited relief for shareholders. But we have to stay realistic. Tariff-related optimism might be a short-lived tailwind, not a permanent fix. Even if the Supreme Court overturns the current framework, the federal government still has several other legal tools it could use to reintroduce tariffs under different names. For example, Section 122 of the 1974 Trade Act allows the president to impose up to 15% tariffs for 150 days in response to trade imbalances. That could buy the White House time to recalibrate and use Section 301, which targets unfair trade practices on a country-by-country basis. Section 301 tariffs would have a stronger legal foundation and could last longer. Another option would be Section 338 of the 1930 Tariff Act, which authorizes the president to levy tariffs of up to 50% on nations deemed harmful to U.S. trade interests. The takeaway is simple. Even if the current tariffs are struck down, the administration could quickly repackage them under a different legal justification. That's why investors should treat this as a temporary catalyst rather than a full reversal of trade policy. For traders who caught today's move, it's wise to lock in gains instead of expecting a one-way recovery. From a technical perspective, Lululemon faces strong resistance near $183, which marks the lower boundary of its prior trading platform. If the stock can reclaim and hold above that level, it would confirm a short-term bottom and signal potential stabilization in both price and fundamentals. However, if it fails to break through or quickly reverses from that level, it risks sliding back toward $163, a critical support zone. Long-term, Lululemon still needs to fix its core business fundamentals, operational efficiency, inventory turnover, and profitability before a true recovery can take shape. The current rally is largely technical and sentiment-driven. Apple and Google collaboration. Let's turn to the tech sector, where two of the biggest names, Apple and Google, announced a surprising new partnership. Apple will integrate Google's AI model into Siri to enhance its reasoning and contextual understanding. It's a fascinating development because, in theory, Apple and Google are competitors. One dominates Android, the other iOS. But competition often yields to practicality. Apple's own AI models still lag behind in reasoning and conversation quality, so for now, it's borrowing Google's expertise to bridge the gap. Google, on the other hand, has little reason to say no. It's a chance to strengthen its AI ecosystem and generate additional revenue from Apple's massive user base. Under the deal, Google's model will handle complex reasoning, summarization, and context tasks, while Apple's in-house models will continue handling simpler functions. The AI computations will run on Apple's private cloud servers, ensuring that user data stays isolated from Google's training datasets. Apple reportedly tested models from Anthropic and OpenAI, but ultimately selected Google's Gemini model as the best fit. The partnership is valued at roughly $11 billion per year, and it will remain in place until Apple launches its own next-generation Siri with iOS 18.4, expected in spring 2026. Today, Google stock rose 2.4%, while Apple was mostly flat on light trading volume. For Google shareholders, this partnership reinforces the company's leadership in enterprise AI solutions. From a valuation perspective, Google's forward target remains $320, implying about 10 to 15% upside from current levels, assuming the broader market stays stable. The stock continues to trade around $297, supported by strong fundamentals and steady revenue growth across its cloud and AI divisions. Qualcomm earnings and valuation. Next up is Qualcomm, which reported quarterly results after the bell. The stock slipped 2.67% in extended trading, even though the earnings themselves were solid. For the fiscal fourth quarter, Qualcomm posted earnings per share of $3.13, beating Wall Street's forecast of $2.87. Revenue came in at $9.81 billion, also above expectations of $9.6 billion. Breaking it down by segment, smartphone, automotive, and IoT chip sales all exceeded expectations. Overall, chip sales rose 10% year-over-year, even after excluding Apple-related revenue. However, management's forward guidance was somewhat cautious. They projected stable revenue growth, but higher operating expenses, especially in automotive R&D. The company showcased new AI accelerator and server chips, but those won't meaningfully contribute to revenue until 2027. The biggest challenge remains customer adoption. Qualcomm needs to persuade data center operators to shift from Nvidia's dominant AI chips to its own. That's a tall order given Nvidia's market lead. Aside from major hyperscalers like Amazon and Microsoft, few customers are currently committed. In terms of valuation, Qualcomm trades at a forward PE of 23 for fiscal 2026, essentially flat compared to fiscal 2025. That suggests limited earnings growth ahead. Technically, the stock remains neutral. Support lies around $151, while resistance sits between $195 and $205. The risk-to-reward ratio isn't ideal, about $15 upside versus nearly $30 downside if it breaks below 150. That's why, from a trader's standpoint, it's not an optimal setup right now. Nvidia's pressure from China and options positioning. Now let's discuss NVIDIA. China has officially banned the use of foreign AI chips in state-owned data centers. This isn't just guidance, it's now a direct prohibition. While Nvidia had already excluded China from its revenue outlook, this announcement eliminates any lingering hope of partial market access. From a psychological perspective, it's a blow. Investors had been holding out for even a small reopening window. With that now gone, sentiment turned cautious. The next key date for Nvidia is November 21st, when monthly options expire. There's heavy call open interest at the $200 strike, meaning that if the stock can break above $200 this week or next, it could trigger more upside momentum. But if it fails, bearish traders could gain control. On the downside, there's a growing cluster of put positions between $180 and $165, suggesting traders are hedging for potential weakness. Much of this shift may have been influenced by large, high-profile investors. For instance, Michael Burry reportedly bought bearish positions recently, sparking a wave of copycat trades. For long-term investors, though, the story hasn't changed dramatically. Nvidia remains the industry leader in AI computing. Strong support levels are visible around 150 to 160, which also aligns with its 200-day moving average. Many institutional players are likely to accumulate if the stock dips to that zone. However, dips of that magnitude tend to be brief. If Nvidia ever touches those levels, it could rebound quickly before most traders have time to react. Waiting for a perfect entry may not be practical. The market rarely gives that luxury. Tesla's shareholder vote and market sentiment. Finally, let's talk about Tesla, TSLA. Tomorrow, November 6th, is the big day. The company will hold its shareholder vote on Elon Musk's compensation package. All signs point to approval. Over the past few weeks, several major shareholders who initially planned to vote against the plan have reversed course. For example, Interactive Brokers, IBKR, faced intense backlash from retail investors, threatening to move their holdings elsewhere if it didn't support the proposal. The pressure worked, and the firm eventually switched to a yes vote. Assuming the plan passes, the next big question is how much profit-taking we'll see. The stock has maintained a strong bullish structure, with little overhead resistance. But Tesla's price action is notoriously unpredictable. It could surge on the news and then just as quickly pull back. For traders, the key is to watch whether Tesla holds its trendline support. As long as it stays above that level, the bullish trend remains intact. A breakdown below support would signal the end of this short-term rally, but for now, momentum remains positive. Broader market view. As for the overall market, the rebound we saw today was encouraging, but not yet decisive. Volatility remains elevated, and the real correction phase hasn't begun. Investors should stay alert, particularly in high-risk sectors that tend to swing sharply after sharp rallies. When true risk-off sentiment hits, it won't be a gradual drift lower. It will feel like a sudden leg sweep, fast, deep, and painful. For now, patience is key. We'll continue to track the S&P 500, NASDAQ, and major support levels for signs of real trend change. Until that happens, these short-term pullbacks and rebounds are just noise within a larger sideways pattern. That wraps up tonight's analysis. Thank you all for your continued support, for watching, liking, commenting, and sharing. We'll be back tomorrow at the same time to break down the latest market movements and updates. Stay informed, stay patient, And as always, invest wisely.